Hello and welcome to the SIE or Securities Industry Essentials training course. There's going to be 20 chapters in this course in preparation for the SIE examination. The introduction should have discussed with you the parameters and specifications of the actual examination. But just a reiteration, Chapter 1 covers the overview of market participants and market structure. That corresponds to Section 1 of the SIE outline, specifically Section 1.1.4 and 1.2.1. Now let's begin the course. Okay, there are going to be 5 main topics in Chapter 1. And a lot of Chapter 1 is going to talk about the definitions. We're going to be using these same terms throughout the course in the other 19 chapters, so it's a great idea to have a general understanding of the terms and definitions. And chapters 1 and 2 is sort of introductory level in terms of they're going to be introducing a lot of new terms that will be covered again in the next 19 chapters. So we're first going to talk about the types of issuers who raises capital, the names of them, and the types of capital they raise, how firms function, the various names of the securities firms and the various departments of those firms. 3, the type of investors that might be applicable in the securities industry. We're going to use the word retail, accredited, institutional. 4th, the difference between what's called the primary and the secondary market. And last but not least, clearing and settlement. So we're going to get through each of these components in greater detail. Now, just a point of edification, I will not be reading the slides. I'll be mentioning certain things on the slides and giving a lot of explanation. But there's no need for me to sit here and read the slides to you, but we're going to talk more about the explanation of these terms and a lot of different examples. Types of issuers. Issuers fall into many different categories. They're entities that generally need to raise capital or want to provide liquidity. We'll talk about liquidity in a few minutes. They could be corporations, IBM, Apple, Netflix, a variety of companies, ExxonMobil. Second would be the U.S. Treasury, the U.S. government, and various government agencies like Fannie Mae or Freddie Mac. These are entities of the U.S. government that are not directly borrowing on behalf of the U.S. government, but specific agencies or authorities. Third, states and local government, the various 50 states, cities, towns. They all have something in common. They need to raise money, raise capital. So, for example, they refer to, state and local governments usually referred to as municipal issuers, and they could raise money for the general funding. They could raise money for a bridge, a tunnel, an airport, a stadium, a library, a college or university, things of that nature. Now, even though banks are technically a type of corporation, we listed them separately because they are a very active participant in issuing securities. So banks could actually have a dual purpose. They could be raising money and issuing securities, as well as helping others buy and sell those securities. And last but not least are foreign governments or foreign corporations as well. So foreign governments can issue securities the same way the U.S. government would issue securities. Second of all, are the types of securities these entities issue. So equity securities represent ownership of a company or an entity. And when you issue equity securities, the usual 2 terms are common stock and preferred stock, which will be covered in great detail in Chapter 3. Now, of the ones listed, only 2 of the issuers will sell equity, and that would be corporations as well as banks. So those 2 sell equities. All of the entities listed can sell debt, which is the second type. So equity represents ownership. Debt or bonds represent the issuer's promise to pay. And debt will be covered in great detail in chapters 4 and 5 of the SIE presentation and the SIE course. So those are the 2 entities, equity and debt. Debt could be issued by all these companies where they're borrowing money, where equity would only be issued by a corporation. So if a company, let's say Dropbox or Spotify, decided to go public and they sold off a percentage of their company, that's referred to as equity. One last note that's going to be covered in detail in other chapters is when these issuers raise capital, primarily corporations and banks, those are the two primary ones. They can either issue securities publicly to everybody or privately to a smaller group of investors. And we'll cover that in great detail in Chapter 11, but just make a note that when companies raise money or borrow money in debt, they can either do so publicly in the public markets or privately. So would you rather sell to a great number of people or a smaller group of people? A larger group would be public and a much smaller group would be private. The next thing we're going to talk about is the term broker-dealer. Securities firms have many different names. They're called brokerage firms, investment banking firms, securities firms, but technically the regulatory name, which is different from some of the slang terms that people use, is called a broker-dealer. And the reason how they got the name broker-dealer is a brokerage firm or securities firm can act in one of two capacities for their clients or investors. And we're going to use the term customers, clients, and investors interchangeably throughout this course. So let's look at that. A broker is an agent or acts as a conduit, finds another party willing to take the other side of trade. Think of it like a matchmaker, someone willing to find a buyer and a seller. And very important, and we're going to reiterate this, is brokers make money through commissions. Brokers make money through commissions. And there is no risk to the firm. So when you think of the term broker, think of the term like real estate broker. A real estate broker doesn't buy your house from you, then resell it to someone else at a later point. They simply find a buyer and act for both the buyer and the seller, sort of like a matchmaker between the two. They have no risk because they're not using their own money. So we use that term, not using your own money or not using your own what's called capital. And we use the term ABC when we talk about brokers because they act in an agency capacity. That's the term used, regulatory term. They are considered a broker, and brokers make the C, commissions. So as you see from the picture, they're introducing, the person in red is introducing the two people on the right and left-hand side, acting in an agency capacity, being a broker, and charging a commission. Now, what if we use the term dealer? So dealer versus broker acts in what's called the principal capacity. And what that refers to is the firm doesn't arrange for another person to take the other side of the trade. They take the other side of the trade. So imagine for a second, you are selling your home, and instead of a broker finding another entity, the person representing you bought the home from you using their own money. That would be called acting as a dealer and acting in a principal capacity and taking the other side of the trade. And the compensation to a dealer is different than a broker. Dealers usually make what's called a markup or a markdown. A markup and a markdown. Markup is when the client is buying and the firm is selling, they'll charge a higher price. And if the brokerage firm is acting as a dealer and buying the securities from a seller, they'll buy it at a little bit of a lower price. That differential, their compensation, is called markup and markdown. It's the same as commission, technically, but there's a different term used. And lastly, they have what's called risk because they're using their own money. And if they keep buying things from people and they can't resell them, they have risk. They're using their own funds, their own capital, and they have what's referred to as risk. Now, let's summarize. Dealers act in the principal capacity. They are a dealer, and what do they earn? A markup or markdown. So make sure when you have any test questions that we know that brokers earn commissions and dealers earn markups and markdowns. We're going to go through a couple of examples, but for right now the terminology is very important. Most licensing examinations, a big part of the battle is understanding the terminology because the terms are going to be used over and over again. Now, not every brokerage firm or securities firm has all these various departments, but we did this here so you could see all the various areas. So some firms might do only investment banking, some firms might only do research, some firms do a little bit of everything. The second issue I want to make sure people understand is that sometimes we use the term front office and back office. Front office usually refers to dealing with clients, and the back office is more the operations part. So the end of this presentation, when we talk about the clearing and settlement and things of that nature, talks more about the back office. We're now going to talk more about the front office. Okay, so investment banking is a big part of many large firms, and they would do the following things. They primarily deal with the issuers. That's their clients. So if an investment banking professional says, I've met my client, or I'm meeting my clients or customers, they're referring to the issuers, as we discussed a few slides earlier, who need to raise capital. So issuance usually refers to new issues of securities. And one of the things they do when they do new issues of securities is they act as what's called an underwriter. So a brokerage firm in investment banking that helps firms raise capital is acting as something called an underwriter. M&A stands for mergers and acquisitions. So when Amazon bought Whole Foods, one firm acted for one of the parties, another firm acted as another party, helping other parties. That's called a merger and acquisition. Third is private equity, which is basically using the firm's own money to make investments in companies. And lastly is kind of working through issuance, debt and equity capital markets. We talked about debt, we talked about equity. When the firms help these companies raise money by selling debt and equity, although it's part of issuance, the specific firm within the department that does that is a subset of investment banking called debt and equity capital markets. Next we have on the side is called research. And research provides research reports to recommend when companies should be bought or sold. So for example, if a research analyst has done a lot of analysis and feels that Apple is an undervalued security, he or she might issue something called a buy recommendation. If they think it's overvalued, it might be a sell recommendation. And they also sometimes have what's called price targets, which is what they think the price of the security might be in the near future. And we also have other areas of the firm. Private client is sometimes referred to as retail brokerage. In some cases, some firms have a division called private wealth management, which might be more catering towards the upper income individuals. But again, it depends on each firm and how they do that. And they're dealing with the investors. And then we have what's called sales and trading, which we'll talk about a little bit later, called the secondary market, is where once those securities are issued with the help of investment banking, they can be bought and sold and bought. That's called sales and trading, and most firms separate that into fixed income or debt or bonds. Again, those terms are interchangeable. Fixed income, bonds, and debt could all be used to mean the same thing, and equity as well, where the firm buys and sells. And we'll talk more about that in the next couple of chapters. And then we have investment management, and that is where the firm's asset management or investment advisory services reside. And we'll talk about the definition of an investment advisor in just a few minutes. Well, there's another term we need to know about, and that term is called information barriers. And some people also refer to an old term called Chinese walls, but the technical term is referred to as information barriers. And the idea is certain information should not be discussed in other areas of the firm. Let me give you two examples. If investment banking is going to be working on a merger and acquisition, they would not want other departments of the firm to know about that because they would trade in advance of that information. So if one company was going to buy another company and the announcement was going to be made in 3 weeks, if the investment banking M&A department disclosed that to other areas within the firm, they'd be violating securities regulations. To remove that, there are various barriers where people cannot speak with other people, and they refer to as information. They may not be physical barriers. In some cases, they could be a different floor, a different department. They're referred to the leak of information. Another example would be, let's say, research. They shouldn't disclose they're going to have a buy recommendation on a stock 3 days in the future and then tell the brokers of the firm so they can buy it ahead. So again, to avoid any problems, a good defense is by having information barriers. Okay, next up, market makers and their quotes. Well, what is a market maker? Let's define that. It's a broker-dealer that chooses to display quotes to buy and sell a specific amount of securities at a specified price. Let's discuss that. We use the term dealer, and dealer simply refers to the ability of using the firm's own capital to buy and sell with customers. Well, what if a dealer always bought and sold that security on a regular basis? So if I bought a security once in a while, once every 3 weeks, or once every month, or once every few days, that's not a regular basis. If I bought and sold on a regular basis, that dealer would actually have a subset term called a market maker. And the term market maker generally applies to equity securities, not debt securities. So if there was a brokerage firm that says, I am a market maker in Apple, that means they stand ready to buy and sell that security at any time. And they actually publicize that to the other brokerage firms. They stand ready to do that. If a brokerage firm says, I make a market in 1,000 stocks, that means they stand ready to buy and sell those 1,000 stocks, which means people know in the securities industry, professionals, that if they want to buy and sell a security and their firm doesn't have an inventory of those securities, some other firm does. And we'll mention a little bit more about this when we discuss what's called the secondary market at the end of this presentation. Now, quotes are firm. Firm simply means you're obligated to buy and sell. You cannot renege on it for 100 shares. The term 100 shares also has another meaning, and that's called a round lot. To make things easier in the securities industry, it doesn't mean you can't buy 150 shares or 28 shares or 480 shares, but in typical units, it's a 100-share unit. So if I said to you, I'm buying 5 round lots, that means I'm buying 500 shares. If I buy 1,000 shares, that's 10 round lots. So it doesn't mean you can't buy an odd number, but most people like to buy in round lots. If you're buying and selling in units of not 100 shares, 50, 80, 25, 18, that's referred to as an odd lot. Let's look at the following chart. Bid and offer price. Let's discuss bid and offer price. Here are numbers, $17.05 and then $17.15. The bid represents a client selling and a brokerage firm buying. So if a customer wants to sell, the brokerage firm will buy from you at $17.05. If the client is buying and the brokerage firm is selling, that's called the ask or offer price. So it says ask or offer represents the client's purchase price. So if the client is buying, the brokerage firm is selling, so the market maker would sell at $17.15. The differential between those two is referred to as the spread. So the differential between the 1705 and the 1715 is referred to as the spread. Now let's cover a couple points here. First, the wider the spread, the more the market maker makes. The wider the spread, the more the market maker makes. The narrower the spread, the less they make. So very actively traded securities generally have narrow spreads, like an Apple might have a spread of only a few cents. A security that's not that actively traded could have 10 cents, 15 cents, 20 cents, $1, depending upon the level of activity. The more actively traded, usually the smaller the spread. Now, the spread represents the profitability of the market maker. We used the term markup or markdown earlier. Let's give an example. The market maker is willing to bid $17.05. If a client's owned stock and sold it back to the market maker at $17.05, they would buy it from them. But they might buy them from them at $17.05 and the client only gets $17. So the market maker bought the stock at $17.05, but the client sees on their confirmation or confirming the trade that they actually only sold the stock at $17. That 5-cent differential will be called the markdown. Conversely, If a client bought stock from a brokerage firm, the market maker would sell the stock at $17.15. So the spread represents the profitability of the market making firm or the market maker, not the individual salesperson. And that would be $17.05. And what if the client actually paid $17.20? That 5-7 differential between $17.15 and $7.20 would be the markup. So markup and markdown are in addition to the spread. The spread represents what the market maker would buy and sell from, and the firm might charge a higher or lower price. Now, consequently, if a brokerage firm was not a market maker and they bought from this market maker, let's say $17.15, instead of being charged a markup or markdown, they will be charged a commission, adding to the $17.15 or subtracting from the $17.05. Now, another chapter will discuss this more in detail, but the key is market makers make spreads, dealers markup, and agents make commission. Okay, next up. Broker-dealers receive compensation based on transactional-based compensation. When you buy and sell, markups, markdowns, commissions. We talked about the investment management or asset management group, and the investment advisor is a term not for a specific person. The term financial advisor could mean that. Investment advisor is a term that requires to a firm that charges a fee for managing portfolios. Generally, the fee is based upon assets under management. So it might be 1% or 1.5% or 2% based upon the assets or the under management. And then what that refers to is the amount of money the advisor is managing. And a second point is an investment advisor could also be considered a large or institutional customer from broker-dealer. So advisors charge fees, but they need to buy and sell securities themselves, and they would be a customer of a broker-dealer. Many large brokerage firms have divisions that charge fees, investment advisory services or investment advisors, as well as broker-dealer charges of commissions or markups. So again, it's important to remember that advisors earn fees based upon assets under management, and broker-dealers receive commissions and markups or transactional-based compensation. Now, there's a special type of investment advisor that deals with state and local governments, and they are known as municipal advisors. Now, the municipal advisor is an entity that advises municipalities on bond offerings, and they must be registered with the SEC. And they typically advise states, counties regarding the structure and timing of a new offering. So, for example, let's assume your town wanted to issue bonds and use that money to build or renovate their school. Well, the people running the municipality may be very knowledgeable about things regarding the town or city or state, but in essence, they may not be experts in the municipal bond market or in the bond market to begin with. So a brokerage firm might act as the underwriter, but who's the intermediary between the underwriter, the brokerage firm that's going to sell these securities, and the town, state, or city that's going to issue those securities? And they are known as municipal advisors, or MAs. I always like to say it's like there's a job for everybody. So if the town has a mayor and the mayor does not know that much about the bond market or needs assistance and wants an outside advisor, they'll hire a municipal advisor. I always like to say that when you learn the information, the best way to make sure you're prepared for an exam is to test the information. So let's do a little activity here. Please open up your workbooks and complete with me the following matching activity. Let's look at the first one. A broker. Now look at the choices on the right-hand side. A broker does what? Answer. A broker receives a commission and acts as an agent. Debt. Debt is when you issue securities and you're borrowing funds. Now, what about an investment advisor? That's going to be next. Investment advisor. How do they get compensated? They charge a fee based on what? Assets under management. What is a market maker? What do? They maintain an inventory of securities. And lastly, equity. What is equity? Is it when you borrow money, or is it ownership of a company? Which is it? It is ownership of a company. Okay, our next group of information is going to be institutional and retail investors. A lot of people ask, what's the definition of a retail investor? You know what the answer is? There is none. There is no definition of a retail investor, so how can I list it? Let's find out. There is a definition of institutional investor, and generally the definition refers to how much money or the dollar value of the assets they're going to invest. So generally speaking, although there's a regulatory definition, we won't get to that now, we want to talk in generalities here. Customers with a large amount of assets to invest, and 50 million or 20 million, depends, are referred to as institutional investors. And primarily, they're not individuals. They are banks, insurance companies, MetLife, New York Life, AXA Insurance, investment companies like BlackRock or T. Rowe Price or Fidelity, they're investment companies. They are corporations who invest their money as well. And of course, individuals with a large amount of money. I don't think an investor like Jeff Bezos, he's a pretty wealthy individual, would be called a retail investor because he's investing so much money. There's also registered investment advisors. Though, remember that we talked about that earlier, where investment advisors charge a fee to manage your money, but when they buy and sell, they're considered an institutional investor. There are also public and private pension plans and hedge funds. Now, we're going to mention hedge funds a little bit later when we talk about something called prime brokerage. There is no legal definition of hedge funds. Generally speaking, they're sort of like pools of money that raise capital primarily from very wealthy individuals and other institutions, and then trade that money, buy and sell securities. So hedge funds don't have a specific definition, a regulatory definition, but one thing they are very, very important customers of brokerage firms because they do so much trading. Imagine an entity that went into a restaurant and ate a lot of food all the time, consumed beverages. They're a good customer of that restaurant. Well, hedge funds are like that. They buy and sell on a regular basis all the time, generating commissions as well as markups and markdowns for brokerage firms. So, if you're not defined as an institutional investor, what are you? By default, you are a retail investor. So any investor that's not considered an institutional investor is retail. Sometimes they use the word non-institutional, but most individuals like the term retail investor. And it could be someone investing $100,000, $3 million. So again, the term retail and institutional investors are defined because institutional is defined, and by default, if you're not institutional, you are retail. Okay, one more slide on the terms. Now, certain terms are defined by certain regulators. So the term accredited investor is not the same as an institutional investor. Please make a note. Accredited investors could be individuals. Accredited investor is someone that's allowed to purchase private placements, which we'll talk about much more in detail in Chapter 11 when we talk about offerings. But as a general term, an accredited investor is an institution plus certain individuals, even retail. They must have either a net worth of $1 million, excluding their primary residence, or annual income of $200,000 in each of the last 2 years, with the expectation of doing that in the future. And for a married couple, it's $300,000. The second term is a QIB, or qualified institutional buyer. And it's another regulatory term, and it's someone way above an accredited investor. It's an entity, a buyer, that must own and invest a minimum of $100 million of securities. We're talking some big money now. And cannot be a natural person. Simply the natural person term is an individual human. So it can't be an individual. So even though Jeff Bezos might invest more than $100 million, he could not be a QIB because he's an individual. But a pension fund could, an insurance company could. They might have well in excess of $100 million. So again, individual investors are known as retail investors. Large investors are known as institutional investors. And then there are subsets based upon the certain regulations. Accredited investors could be individuals as long as they meet the net worth or annual income requirements. And then last but not least are the term QIBs, or qualified institutional buyers, which are very large institutions that meet the $100 million minimum. Okay, the next thing we're going to talk about is some terminology. Now, the primary market is sometimes referred to as the new issue market. That's where the issuer is selling securities, they need to raise capital, and they hire an underwriter. So an underwriter is a brokerage firm that usually the investment banking department works with, that buys the securities from the issuer and then resells those securities directly to the investor. So the underwriter facilitates distribution. They might have some type of liability because they bought the securities, and they sign an agreement with the issuer to underwrite. Underwrite is simply a term that means buying the securities from the issuer and reselling them to investors. In many cases, the issuer doesn't know about the investor, or the investor doesn't know about the issuer. The connection between those two is called the underwriter. Now, a couple of other terms, and that is IPO versus follow-on. Again, these terms only apply to equity securities. If a company is going public for the first time, that's called an initial public offering, or IPO. So when Spotify went public for the first time, that was an IPO. When Apple went public for the first time many years ago, that was an IPO. If one day in the future a company like Uber does an IPO, that will be the first time they're going public. In many cases, existing companies, when they do the IPO, they don't sell 100% of the company. They might sell 20% or 30%. And one of the reasons they don't is because they may want to sell securities later on. And if they do that, that's called a follow-on offering. So, if a company like Tesla, the automobile company, does an IPO, and sometime later on, after they do an IPO, they need to raise money to build a new battery plant, they might decide to sell a bigger equity stake. So instead of selling, they've already sold 20%, maybe they'll sell another 10% of the company. If an existing company sells equity securities at a future point in time, that's called a follow-on offering. So again, IPO is the first time. Any subsequent sale is a follow-on. They could have one follow-on, then they could have three follow-ons, but just the terminology. Now, in addition to the primary market, there is the secondary market. And the secondary market refers to trading of companies that have gone public through an IPO, and they're being bought and sold to and from other investors. So if I buy security directly from the issuer in an IPO, that's called the primary market. If I then sell those securities, that stock, to someone else, that's called the secondary market. If that person sells to another person, and so on and so forth, that's called the secondary market. Now, within the secondary market, there's something called an exchange. And for many years, when people thought of the word exchange, they only thought of a physical exchange or a centralized location, most common being the New York Stock Exchange. But as we'll see on a few other slides, there are other types of exchanges which are electronic, which are not a physical location. Now, one of the interesting things about an exchange is they did have what's called a market maker, which we talked about earlier, but they would only have one market maker, and the term used for that one market maker would be called a specialist. That term has now been replaced by the term DMM, or designated market maker. And other exchanges include the New York Stock Exchange, MKT, formerly known as the American Stock Exchange, which was purchased by the New York Stock Exchange. We have Boston, Chicago, Pacific. There could be others, but we don't need to know too many of those. Generally, the most important of those is the New York Stock Exchange. So, for example, if a brokerage firm wanted to buy or sell, let's say IBM stock, which is already public, and they wanted to buy a large number of shares. A client does, they go to their brokerage firm. Their brokerage firm might say the best place to execute that trade is on the floor of the New York Stock Exchange. So I want to buy IBM. Where do I buy IBM on the floor? They will go over to the trading post, where the designated market maker would almost act as an auctioneer, and they would try to buy the securities on behalf, or assist me in buying those securities, finding another sell. Think of like a matchmaker, as well as someone who's looking to facilitate the transaction. One thing that's very important for the SIE exam is we don't need to know such legal definitions. We have to know a general understanding of the material. Other exams, what we call the top-off exam for, let's say, Series 7 or 79 or other exams, might need to know a lot more detail. So the idea is this is more of an introductory level terminology, and some of these terms will be discussed again in other chapters of the SIE as well. Now, we talked about other marketplaces besides exchanges. Physical exchanges are centralized. And the term exchange simply refers to the bringing of buyers and sellers together. Well, one of the biggest exchanges is actually not a physical location, and it's called NASDAQ. NASDAQ is a computerized network where markets are negotiated, and a key factor is an unlimited number of market makers. So, for example, on the floor of the New York Stock Exchange, there's only one designated market maker for IBM, or for Hewlett-Packard, or for Disney. Apple, which trades in NASDAQ, Facebook, which trades in NASDAQ, could have over 100 market makers, individual brokerage firms that always stand ready to buy and sell those securities. So even though it's not a physical location, NASDAQ is still defined as an exchange. What else is there in the marketplace? Well, a second entity is called a non-exchange related issue, or the over-the-counter market. Now, in order to be listed on NASDAQ or the New York Stock Exchange, the company has to meet certain requirements. Well, there are hundreds or thousands of companies that either choose not to list on an exchange or are too small to list on an exchange. And they're referred to as non-exchange traded issues. Let's talk about them for a minute. Sometimes referred to as the over-the-counter market. They could be low price, sometimes penny stocks, but not always, of course. And they could be thinly traded. In other words, there's not that many market makers. Now, there are two systems. Now, it's very important to remember, these are not exchanges. Please make a note in your materials that these are not exchanges. They are quotation systems. One is called the OTCBB, or the Bulletin Board, and the other is called the Pink Markets, or Pink Marketplace. The reason how it got the name Pink is many years ago, it was actually done in paper, and the color of the paper was called the Pink Sheets. It's electronic now, but the name simply stuck. Now, again, they're quotation systems. Here's kind of the way it works. Let's assume you contact your customer, you contact your brokerage firm and say, I'd like to buy 1,000 shares of Nintendo stock, which is a Japanese company. That Japanese company, for a variety of reasons, does not trade or is listed on any U.S. exchange. So let's go through the example. You want to buy 1,000 shares of Nintendo. You contact your brokerage firm. Your brokerage firm says, well, you want to buy 1,000 shares. We don't make a market in this stock. It's not something we'd regularly buy and sell, and there's no reason to make a market in the stock. So they would go, your brokerage firm would have someone called a trader, which we'll define in just a few minutes, and that entity, that person at the firm, would find out what brokerage firms are willing to make a market in Nintendo. And they would access one of two systems, the bulletin board or the pink markets, which are quotation systems, and look at which brokerage firms or brokerage firm is willing to buy or sell shares in Nintendo. The brokerage firm would then buy the shares for you, act as your agent, and charge you a commission. And the last two terms are market makers, which stand ready to buy and sell at least 100 shares, always at the same time. So that firm that was contacted was called the market maker, and they're subject to something called SRO, or self-regulatory organization rules, which will be discussed in the next chapter in detail. And lastly, we have the trader. And the trader executes trades for the firm or their clients and does not maintain an inventory. So again, the person at the brokerage firm who bought Nintendo stock was called a trader. They bought those shares from an entity known as a market maker, a firm that stands ready to always buy and sell. Sometimes people ask, why would a firm make a market in a security? Well, the best answer is, if the firm knew their clients always wanted to buy or sell those securities, that would be one reason, among others, they would make a market in that security. Lastly on this section, let's just define a couple of other secondary market terms. These are simply definitional terms. The third market. The primary market is new issue. The secondary market is where securities are traded after the primary market. The fourth market, and then we have dark pools. Those are the three terms. Now let's talk about third market, fourth market, and dark pools. Third market. Listed securities traded over the counter. So for example, if IBM or Disney is listed on the New York Stock Exchange, but someone buys and sells that away from the floor of the New York Stock Exchange between other brokerage firms, that's called the third market. Now the fourth market is a transaction between institutions. So in other words, it's sort of like a crossing system where institutions, which we defined earlier, can buy and sell to and from each other. So if a bank buys directly from a pension fund, that's called a fourth market trade. Well, what do you use to execute fourth market trades? Well, that's the last point, called a dark pool. And the reason why they referred to as dark pools, and this is a key fact for the exam, it's anonymous. Dark pools allow institutional investors primarily to buy and sell to and from each other, but remain anonymous. There's also a point on the slide that says high-frequency traders. That's simply a term for these small firms, so this could be a little larger, where they buy and sell very, very quickly. They're always buying and selling. That's how it got the name high-frequency traders. The quotes in these dark pools, another reason why they're called that, are not disseminated, so it would limit the impact on the public markets. Now let's do an activity. Let's go to the workbook, and we're going to fill in some blanks. To be considered an accredited investor, an individual must have a net worth of X or annual income of X. And the answer is $1 million of net worth or annual income of $200,000. Next, a qualified institutional buyer QIB cannot be a blank and must own and invest a minimum of X. They cannot be a natural person or individual and must own and invest a minimum of $100 million. Next, an issuer may hire a blank to assist in selling securities publicly to raise capital. That would be the primary market, and that would be an underwriter. 4. The blank market is where issuers raise money by selling securities to the public. Answer: the primary market. The blank market is where trading of existing securities between investors occur, and that would be called the secondary market. Blank is considered a registered exchange with an unlimited number of market makers. NASDAQ. Remember, the New York Stock Exchange would have a designated market maker, 1. 7. Blank stands ready to buy or sell security at the quoted price, while blank executes trades for the firm or the firm's clients. A market maker stands ready to buy or sell, while traders execute trades for the firm. And lastly, a transaction executed between two institutional investors or institutions is considered a fourth market trade. Excellent. Okay, finally our last section is the clearing and settlement, sometimes referred to as the back office. DTCC is Depository Trust Clearing Corporation, and make a note to the side of that one of the main subsidiaries is called DTC. In fact, many people use the term interchangeably, DTC and DTCC. Depository Trust Corporation, they don't actually hold any securities. It's a book entry system because most firms, brokerage firms, when they buy and sell for customers, they do it in what's called street name. Let's talk about that for a minute. So if I buy securities as an investor from a brokerage firm, the brokerage firm buys the securities on my behalf, and then the record keeping doesn't say my name, it says the name of the brokerage firm. That's called street name. The reason I got the name street name, Wall Street, street name, that's just how that originally got started. And so if I buy securities, they're held in street name, and I sell those securities to a customer of another brokerage firm, DTCC or DTC will transfer ownership in book entry form from one brokerage firm to the other brokerage firm. So they don't have the names of the actual customers, the brokerage firms do, but they simply have the name of the brokerage firms. The NSCC, the National Securities Clearing Corp, is for the equity side of clearing the trade, the back office. FICC is Fixed Income Clearing Corp, and that's for debt or bonds. Then there are clearing firms, which is the name of the brokerage firms who do the back office. And firms can either clear their own trades, or smaller firms are known as introducing firms or correspondents. And they can clear their trades on an omnibus or fully disclosed basis, which are our next slide. But before getting to that, let me explain the term introducing firms. There are a few thousand brokerage firms, and many of them are smaller firms. So it doesn't pay for them to have their own back office. So what they do is they use the services of a big brokerage firm who's got excess capacity, who will not only clear their own trades, they'll provide a back office for smaller firms. Those smaller firms are known as introducing firms. They're introducing those customers to the clearing firm that provides a lot of back office functions for them. Now, when introducing firms clear their trades, there are two ways they can do it: fully disclosed or omnibus. The vast majority are fully disclosed, and that's where the clearing firm knows everything there is to know about the customer. So in essence, the introducing firm is doing very little, if any, back office. All the customer account statements, all the funds, all the assets are maintained by the clearing corp. So on a fully disclosed basis, all customer record keeping is done by the clearing firm. They know who the client is. They know all the information about the client. So when the client receives the statements, they're from the clearing firm, and it says clearing on behalf of the smaller introducing firm. The second way is omnibus. Now in that case, the brokerage firm, that's the introducing firm, doesn't give up the identity of the customers. They'll simply say, buy securities for these accounts, buy securities for our account, buy securities for our account. So they do the record keeping. So one of the questions that could be asked on the exam is, who keeps the books and records? Well, if it's a fully disclosed account, the clearing firm does. If it's an omnibus account, the introducing firm would keep all the books and records. The question is, from a business standpoint, how much paperwork do you want to do? If it's a very small amount, you do fully disclosed, which you pay more. If it's an omnibus, you do some paperwork, but some of the other paperwork is done by the clearing firm. So it's going to cost you, as a small firm or introducing firm, more money to create the omnibus account. Now, another way to summarize this is by looking at the DTCC as compared to the OCC. And we'll discuss it in just a minute. The DTCC, as we talked about, is Depository Trust and Clearing Corporation, provides clearing services. What they do is they guarantee settlement between the brokerage firms. So brokerage firms deposit funds with them, and they're simply moving the funds around. So it removes what's called counterparty risk. The clearing companies remove counterparty risk is they act as a buyer for every seller and a seller for every buyer, but they don't interact with customers. They interact with brokerage firms. So brokerage firms have funds on deposit with the DTC, and the funds are simply moved around. But DTCC is primarily stocks and bonds, with the NSCC being stocks and equities, and the FICC being mostly debt. What is the OCC? The OCC is the Options Clearing Corp. And what they do is similar to what the DTCC does, but for options. Now, option we discussed in detail in Chapter 10. But for right now, you need to know that OCC, the Options Clearing Corp, guarantees all option or exchange-traded options or listed options. So they're the ones that would create no counterparty risk in the option market, where the same function would be done by the DTCC for equities and fixed income. So when brokerage firms do clearing, they can set up omnibus or fully disclosed. Let's talk about one other methodology of clearing, and that's called prime brokerage. Think of prime brokerage as first-class brokerage, not coach, not even business class. So when hedge funds buy and sell securities, they tend to use many different brokerage firms to buy and sell. Well, they don't want to have 10 different brokerage accounts. What they'd like is to have one brokerage account and some entity to act as an intermediary to provide custody, securities lending, margin, clearing, everything. Full clearing capability. I don't want to deal with 10 firms. I want to deal with one. That's why they created prime brokerage, to have a clearing capability for the hedge fund community. So instead of having 10 different brokerage accounts, they have one. Now the next chart will give you a good idea of how prime brokerage works. PB is the prime broker with dollar signs, and we have the institutional customer. The institutional customer could do equity trades with a number of different brokerage firms. They're called executing firms. It could be 1, 10, 20. They might do bond trades. They might do derivative trades with all these different brokerage firms. How do these brokerage firms, they execute the trades, but how does the customer, that institutional customer, that hedge fund in the lower left-hand corner, how do they get account statements? Well, the prime broker consolidates all that information and sends that information back to the prime brokerage client. Pretty interesting. So there's a kind of a flow-through that allows an institutional customer like a hedge fund to buy and sell using multiple brokerage firms, but only have one clearing broker, known as their prime broker. Okay, let's now go through a question. Okay, as it relates to method of clearing and settlement, which of these statements is or are true? So there's 4 statements there. Please read them. And let's look at the correct answer. Choices 1 and 4 are true. Clearing firms are responsible for maintaining client account records in a fully disclosed. Omnibus would be the introducing firm. And the OCC does not deal with clients. It deals directly with brokerage firm, not customers. Okay. Our final activity is a matching concept. The buyer for all sellers and the seller for all buyers is the Options Clearing Corporation for options, and it would be the DTCC through for equities and fixed income. Trades from multiple firms clear and settle through one firm. That's referred to as prime brokerage. Clearing firm is responsible for individual client information, would be a fully disclosed account. And an introducing firm that's responsible for individual client information would be an omnibus account. This concludes Chapter 1. What's next is the very exciting Chapter 2, which talks about industry regulations, both federal and state regulations, as well as SROs or self-regulatory organizations.